You can go ahead, Angela.
Thank you, Alex. Thank you, everyone, for joining us today. My name is Angela C1, and I am a volunteer with the ALS Society of BC and a facilitator of the in-person Burnaby ALS support group. It is my pleasure to welcome you to Patient Information Webinar Series number 13. Before we begin, please note that today's webinar is being recorded and will be posted on the ALS Society of BC website for future viewing. We will have time for questions and answers and at the end of the presentation. So please submit your questions using the Q&A button at the bottom of your screen. All questions are anonymous, so please feel free to ask whatever is on your mind. The Patient Information Webinar Series is proudly presented by Shionogi Canada Inc., and we are grateful for their ongoing support in helping us bring valuable and educational programs to the ALS community. Today, we are delighted to welcome Harry and Jani from Jani CPA Ltd. Jani CPA Ltd. is a BC-based accounting and advisory firm serving privately held businesses, entrepreneurs, and not-for-profit organizations. The firm provides accounting, tax, assurance, bookkeeping, and outsourced CFO services, helping clients improve financial performance, strengthen reporting, and make informed business decisions. Harry Jani is a chartered professional accountant who advises business owners and organizations on accounting, taxation, financial reporting, financing, and strategic planning. He is known for providing practical, business-focused advice and often serves as an outsourced CFO to support growth and financial management. Jani is a chartered professional accountant specializing in financial reporting, taxation, budgeting, and cloud accounting solutions. He works closely with business owners and management teams to improve financial processes, enhance reporting, and build scalable systems that support long-term growth. In today's session, Jay and Harry will explore tax and estate planning strategies available to individuals and families facing significant disability-related care costs. Topics will include the disability tax credit, medical expense claims, caregiver-related tax benefits, and important estate planning considerations such as TFSA designations, charitable giving, and spousal rollovers. Attendees will learn how to maximize available tax relief and integrate estate planning into a broader financial strategy to help reduce the financial burden associated with long-term illness and disability. Please join me in welcoming Harry and Jay. We are grateful to have them with us today and looking forward to learning from their expertise. Thank you.
Thank you very much, Angela, and thank you everybody for joining us. My name is Jay, and Harry here is to the right of me. Easy to get us mixed up. We look very similar, but we're very happy to be here and welcome again. So I just want to jump right into it. So I'll skip some of this over here, but when we look at the ALS community and the organization itself, it's something very close to home, and we've learned quite a lot about the process, and especially the financial side of things from our own family's experience with ALS. A close family member was diagnosed with ALS, and one big thing was, despite our background and experience in accounting and finance, we ended up missing a lot of the valuable tax saving opportunities and financial steps that we should have taken. And it was because our focus was primarily directed on the PALS quality of life and adapting to the rapidly changing environment and needs and accommodations that come with the illness. So one of the big things is, and reflecting on our experiences, it was definitely an overwhelming experience. Just as, one thing started working, something else would come up and we'd have to, collectively gather everything and figure out how to deal with that next change. And the biggest takeaway is having a clear path and the right guidance in place is critical to moving forward. And the idea of this presentation is really to, make that financial side a little lighter for everybody. So the way we kind of want to structure this specifically is by focusing on questions. So when we think about tax and financial planning, it's a lot easier to simplify things when we look at these complex topics by looking at specific questions. So specifically for individuals with ALS and their families, there are really three key questions that really keep coming back during our discussions. So the first is, could the disability tax credit help you? The important side of that question is really to get you thinking about not just the diagnosis itself, but understanding how your day and the patient's day are being impacted and how their day-to-day activities are affected from the illness. The second is, what medical costs may qualify. So the idea here is costs can become significant, and generally they're associated with care, equipment, travel, accessibility, and then obviously changes within the home, and the tax treatment is not always obvious. And we want to keep thinking about this, and we want to have that at the forefront of our minds so that we're in the right planning stage. And then the third is the estate plan aligned? So as circumstances change, it becomes very important to consider things like, beneficiary designations, ownership of assets, who has the right authority in place to make financial decisions and health decisions, and making sure that is all taken care of today versus when things become, more advanced. The important point here that we really want to stress is, when we think of these questions, they're not independent thoughts or to be thought about in isolation. They're really to be considered together. So when tax credits and medical expenses and estate decisions are considered as a group, that's where we start to get what we call holistic planning. So one of the biggest things that we definitely want to emphasize first is that, good planning should reduce the burden on the person living with ALS, not add to it. So clearly there's already an incredible amount of things to manage, from medical appointments, changes in care, equipment, accessibility needs, and just simply maintaining quality of life. So tax and financial planning paperwork should not become another project for the person living with ALS, and not really be something for them to manage directly. So what we look at is a very simple approach to help this kind of move forward. Our goal is to reduce the burden, simplify everything by assigning a single point person for collection, coordination, and action. And that point person generally, again, should not be the PAL. It could be potentially a family member, a trusted advisor, or a third-party representative like a CPA or a social worker. The goal there is the point person would be the individual who coordinates all the records, stays on top of deadlines, and kind of compiles those professional questions that would go out to third-party professionals. The idea also is, the patient with ALS will have limited involvement in that process. And really, we only need to involve them when a decision truly requires their input. And one key takeaway for everybody to note is when someone needs authority to act on their behalf, we always need to make sure that the appropriate legal documentation is in place and documented. So the real takeaway here is, ultimately good planning is not only about protecting money, but it's also about protecting time and energy and making sure both are being directed towards things that matter the most. This is just a slide to kind of give us a little bit of a roadmap. So we're going to jump into the DTC side of things, so disability tax credit. So for those who are new to it, the disability tax credit is a non-refundable tax credit designed to help with costs associated with the disability. So some really key clarifications. So the DTC is not a monthly cash payment, and it's not a cash reimbursement for costs incurred. It was really designed to help reduce the amount of tax payable to help offset additional costs associated to managing an individual's disability. So sometimes when an individual has a disability, it becomes more to a point where the individual no longer requires to pay tax or cannot use the full amount of the disability credit. The great benefit of this disability tax credit is it's transferable, which means you can transfer the credit to a qualifying supporting family member who may be able to use some of the credit or all of the credit that was not used by the patient. And another great thing is the disability tax credit is applied retroactively to the year that impairment began, and we're eligible to take it back almost or up to a maximum of 10 years. If you are approved, you would be able to reassess prior tax returns for those eligible years, which could potentially result in tax refunds for any previous taxes paid. Obviously, refunds are not guaranteed, really dependent on your eligibility period, your personal tax situation, and any amount of tax paid previously. So one key caveat that I do want to mention is applying for this credit right away, and the earlier you apply for it, the better. So one big point too is the disability tax credit is worth exploring, even if reducing taxes is not your family's primary concern. And the reason we know that is we call the disability tax credit essentially a gateway benefit. So what that means is once you are approved for that benefit, it opens the door to a bunch of other federal programs and benefits. For example, the Child Disability Benefit, Canada Workers Disability Benefit and Supplement, Registered Disability Savings Plan, and the new Canadian Disability Benefit. So we won't go into too much detail about the actual numbers here, but high level, in 2026, the federal disability amount is $10,341. At 14% of the federal non-refundable credit rate, that can reduce your federal taxes payable up to around $1,400. The key caveats and takeaways here is to remember it's a non-refundable tax credit, so this is not a cash payment or an automatic refund. The actual benefit really depends on how much tax is otherwise payable if this credit wasn't in existence. And then a big takeaway here also is there may be additional separate provincial territorial disability credits and benefits that are available. And that really depends on your personal situation and where you live and that jurisdiction's tax rules. So to reiterate, in some cases, unused amounts may be able to be transferred to qualifying family members if they provide, basic necessities for life. So it's really important to apply for that application, even though you think it may not be worthwhile at the time. It definitely adds value. So when we talk about eligibility, it's very important to kind of look at it in a different light. So the CRA bases eligibility on impact rather than diagnosis alone. So what does this really mean is, there are no age restrictions or there's no income or asset testing. It's not based on your ability to work or go to school. That also means it's not based on solely the diagnosis of ALS. Instead, eligibility is tied closely to the nature of the impairment, its impact, specifically severe and prolonged mental or physical impairment, and they refer that to as what's called a marked restriction. So when we're looking at eligibility, CRA generally considers whether a restriction is present all or most of the time, so 90% of the time, and is expected to last for at least 12 continuous months, as well as severely impacts your ability to do specific activities or results in significantly more time, 3 times as much time than an average person to do that activity. So generally what happens is you would kind of compile these facts, you would see your medical practitioner. The practitioner would certify, where you fall within those marked restrictions and impairments, and then that would take you to the next step of the application. So kind of diving more into this, the diagnosis again is not enough. ALS, it is a severe diagnosis. Unfortunately, the CRA hasn't taken the approach to automatically approve applications. That is something that's being discussed in the future. But CRA is really today looking for the functional impact of ALS. So when we look at an application, it needs to explain what specific activities of daily living are restricted and how those restrictions are affecting your daily life. And then when we're looking at, building out our application, we need to build the responses around the CRA eligibility test. So for each limitation, we want to clearly address, whether the activity cannot be performed. Is it taking significantly longer to do? How often is the restriction present? And how long has it lasted or expected to last? And then finally, when we look at the application as a whole, it should tell a complete functional story. So what I mean by that is we want it to specifically identify the affected daily activities that are impacted. It needs to provide practical examples and explain how individual restrictions or their cumulative effect meets the threshold of a marked restriction. So CRA gives you, several different categories to address. You may not hit all those categories, but the common ones that we've seen are speaking, walking, feeding, dressing, eliminating, and life-sustaining therapy. So when we look at, moving into the application phase, I think the most important thing is clearly demonstrating how the diagnosis is restricting your ability to perform one of these activities or one or more, and identifying the severity and frequency of those restrictions. So with ALS, it's a progressive condition, and there's different ways to actually meet eligibility. So one is obviously the marked restriction route. Then you have a cumulative effect route, and then a life-sustaining therapy route. So a marked restriction, like I was saying, is you're unable to perform a basic activity of daily living, or it takes you at least 3 times longer than a person of similar age without that impairment. And the restriction is present in 90% of the case of the time. And then most importantly, it's a prolonged impact. So it's either expected to last or has lasted continuously for 12 months. When we look at cumulative effect, what this is specifically in relation to is when we look at, the several categories, you may have, limitations in each category, but not as severe as a marked restriction that we're referring to. And the CRA will allow you to combine the impacts and effects that you're experiencing in several different categories. And that would be considered equivalent to a marked restriction and eligibility. And then the final one is life-sustaining therapy. This category and route is quite strict. Everything has to have a detailed purpose. There has to be specific frequencies and time tests that apply. So the rules are fairly detailed and complex. And I think the best route, if you're going to take that, is looking at a professional consultation before going down that path. I think the thing I want to clarify when we're looking at, the different types of routes to the application is, since ALS is a progressive condition, generally a person will not initially have one single marked restriction. So the only way they would move forward is effectively qualifying through cumulative effects. And that's really in reference to, let's say, over time, walking, dressing, feeding, speaking limitations all combine into a significant effect. And then what CRA will do is they'll determine your eligibility based on the information given by your medical practitioner. And over time, you can add additional information as things progress. But the key caveat is make sure an application is submitted as soon as something, a limitation has come up. So preparing and submitting a strong application. So kind of like a cheat sheet here when we're looking at the application. So the most useful tool here is kind of preparing a short functional log. So that log, is the idea there is to give concrete examples of issues or your day-to-day. So for example, distance walked, how long it takes you to dress, assistance needed to eat or communicate, or time or rest breaks that are required throughout your day-to-day activity. And when you have all this together, it makes it much easier for the practitioner to make an independent medical certification. So the idea is not to give them really a scripted conclusion, but really to give them just right information to make that decision and certification. So some of the key things that I always recommend is, using the exact activity affected per CRA's categories versus a general statement. So a doctor normally will put out a statement like mobility is poor. We want to see the actual category of walking and what the effect is. We also want to state, what the typical task is, a comparison with someone of a similar age without an impairment. We want to see actual time, physical assistance, supervision, rest breaks, devices used, and safety risks included in your discussion. Frequency, including the good and the bad days, why the restriction is still present 90% of the time if it's still accurate. And most importantly, we want to document the start date of, functional restrictions. So the start date may differ from when you're diagnosed with the illness. And then you want to also keep track of expected duration and progression of the condition. So I think the most important thing here is, when we're documenting these things, we want to consider how we're impacted on a combined approach, because when we look at the combined impact of two or more significant limitations, that will be considered as a qualifying factor for the credit. So application routes, there's two routes to apply. There's the digital approach or using a paper form. We always recommend taking the digital approach. Sometimes medical practitioners don't want to go that direction, so that's why they do have the paper form. With the digital option, the applicant or legal representative completes Part A of the form. It's very straightforward to complete that part. Basically, it's including your personal information, name, birthday, information like that. One really important section of the form specifies if you have a caregiver or an individual close family member that you're planning to transfer the credit to. Even if you're not sure about transferring that credit, it's always best to put that individual in there upfront so that they're already on the record, because the CRA is super backlogged. They take time to put everything in order. So getting everything done upfront is best practice. Once we've completed, Part A of the form on both sides, you'll take Part B to the medical practitioner. So in the digital side, you would apply through your CRA online account, hit submit, you'll receive a physical code. You take that code to your medical practitioner and they can log into a portal and complete their portion and digitally submit it to the CRA. The paper form side, you'll take your physical paper form to the medical practitioner. They'll fill out the details with yours during your meeting, and you'll have to physically mail that form to the CRA. The biggest benefit of the electronic form is it provides clear guidance on how to populate it. And there's a tracker that's online on your CRA account that lets you see where you're at and if there's any follow-up. Snail mail, you don't get any of that information. And then one other caveat too is we just recently read the rules that CRA is potentially changing the T2201 paper form. And that I think is rolling out very quickly in the pipeline. So I would imagine that medical practitioners are not going to have the updated form in time of when they launch this new path, which would result in your application potentially getting declined if it is on a paper application. So how to complete the form? So there's obviously the simplest support that fits your situation is the rule of thumb. So option one is doing it yourself. This is best when the facts are clear. The family has the time and capability to manage the form. Your prior tax returns are very straightforward. So the best practice is start with the CRA side, fill out your details, and then speak with your medical practitioner. Option two is working with a CPA. This is best when things are more complex. So if you're going to do a credit transfer, or you have significant or large care costs, and your prior tax returns were more complex and they need review, and if there's estate decisions that overlap. So effectively, you want to incorporate tax planning in the process. And the idea here is, you want to specifically scope project with your CPA, a practical review, not a very large project or robust project. And that's to keep fees accordingly. And then the final approach is using an ATC consultant. The key recommendations here are normally these are percentages of the actual funds received back. So we always say understand the fee structure, avoid assumptions that approval is guaranteed, review your engagement letter and your fees carefully, and be prepared to actively provide supporting documentation throughout that process.
Perfect. Yes, thanks, Jay. So now we've covered the DTC. We want to talk about medical costs and go into some of the details of capturing those costs, making sure that everybody understands that they're actually eligible to claim it, things like that. So we're going to go into that section now. So we always see the first job is to save the information, not decide whether every item qualifies as an eligible expense. So save it and let a professional decide that. So make sure to keep all your receipts, invoices, and maybe attach a brief note explaining why the expense was needed and record it as an item in there. Also, we also recommend to note if any portion of that was reimbursed by an insurance company or another program like a grant or anything like that, because those portions would not be able to reduce your taxes and pay them as medical expenses. And some credits require additional support like prescriptions or medical certifications. So make sure to keep those on record as well too. And you can either hand those off to your tax preparer, accountant, or your legal representative who's helping you prepare your final tax return. And generally only eligible amounts that were not reimbursable can be claimed. So when I'm talking about eligible amounts that are not reimbursable, is we're really talking about items that you physically paid for. So make sure that you're not including things that were given by, different societies and things like that, and other items there. So there's a few ways you can keep these receipts. The most optimal way is through a spreadsheet and almost a shared folder where people can drop the receipts and you can have them on your computer or your phone or something like that. The more traditional way of doing it is putting them all in an envelope and providing them to whoever's preparing your taxes at the year end. So it's just making sure that you're capturing all the costs and you're not losing those receipts, because every dollar really helps you out in the journey that everyone faces. So we're going to start with some of the more familiar medical expenses, and then we're going to move to costs more closely associated with ALS. So some of the more familiar expenses, many people might be already familiar with these. The common expenses include prescription drugs, eligible medical supplies, and prescribed equipment. Some of the other ones include fees paid to eligible medical practitioners, hospitals, ambulance services, things like that. Other chiropractors may also qualify. Sometimes I've seen people miss premiums paid to qualified private health service plans. Those are also eligible in cases as well too. And another common one that is sometimes forgotten is medical travel. So if there's transportation costs that are greater than 40 kilometers one way, those are eligible, and it's a specific claim that you can claim. If it's 80 kilometers or more, meals, parking, and allowances are also eligible along with the transportation costs. So it's really good to know those items and those costs. You do incur them, so you should be able to claim a medical expense for those on your taxes. Know that the services generally must not be available closer to your home if they're travel expenses related. So say, for example, if I'm wanting to go to a preferred hospital or medical center rather than one that's closer to my house, and there isn't a valid reason for that, then they may be denied. But if there is a valid reason to go to a specific center, maybe it specializes in a number of items, then make sure to have that documented so that those claims will be approved. Now we'll go into the more specific expenses and items related to ALS, which maybe some of you have encountered, or it's great to get a good understanding of what these might look like in your journey. So as ALS progresses, costs can arise in several areas. For mobility and transfers, examples might include wheelchairs, walking aids, lifts, stair chairs, bathroom aids, things like that. So there's a bucket list of items there that are specific to mobility and transfer items and things like that. Then I'd recommend everybody go and look at. Other items include breathing and home care costs. Those might include ventilators, prescribed oxygen equipment, hospital beds at your home residence, attendance or nurse cares. Those are, substantial costs that there are some tax advantages to claiming those as well too. And then other respite care. So it's really important to get a good understanding of which ones you might be having to incur and which ones might be covered from a number of grants and bodies that provide those. So communication expenses are another one, which are huge. So speaking aids or certain communication devices and medically certified voice recognition software. Those tend to be expensive units. So if you had to pay for those on your own, including those really helps you out as well to buy those items. Some of the other items are also any kind of alterations which you might have to your home, which might include widening hallways for wheelchair accessibility, widening doorways, lowering cabinets, maybe renovating bathrooms to be more accommodating. And sometimes those account for more than just one deduction that you can get. So you might be eligible for home accessibility tax credit along with a medical expense tax credit, which is a benefit to you and your family. So I want to go into a little detail about the attendee care claims and how they interact with the disability tax credit that Jay was mentioning earlier in the first segment. So the biggest thing to note here is attending care and facility claims can interact with the disability tax credit, which means that there's limitations on claiming attendee care or the disability tax credit. And these limitations need to be investigated in detail and to determine the best claim possible. What I want to go through here is just some high-level items. So the best claim isn't always the largest receipt. So if you had attendee care that you had a large amount for, maybe it's more beneficial to claim the disability tax credit rather than that attendee care. And it just really matters on the specific scenario that you have and the dollar amounts that we're talking about. So what I recommend is before filing, request a breakdown of the care wages or expenses if they're employees or if they're consultants, things like that, and compare the available options. Consult with a tax advisor, and they can help you determine which choice is more beneficial to you and which route would benefit you or your long-term goals. So family members providing support should also consider the Canadian caregiver amount. That's something that I want to talk about. Also, say that attendee care is a family member rather than someone hired. There's also credits that you can claim for this. One was called the Canadian Caregiver Credit, and it's separate from the disability tax credit. There is some restrictions on applying for this or receiving this credit, and it does get very technical. So I'd recommend, going into a little bit of detail with your tax advisor, doing a little bit of research on this item to see if you do qualify. So eligibility and the amount depend on a few different factors. Those factors are the relationship, whether the person is dependent of the support, the dependent's income, the residency rules, and other credits which are being claimed. So that's what I'm saying. It's really technical and it really depends on that specific situation that we're looking at. So that kind of gives a glimpse of some medical expenses and what also is available, the Canada caregiver amount and things like that. I want to now turn the focus on towards a little bit of a estate and family planning, because I find that's the most important aspect that some people forget to do. So the last one here is the last question that we're talking about was, is the estate plan aligned? So making sure all these three are kind of aligned together, and we want to make sure that this is aligned as well. So what does that mean? It means that your estate plan in this context is not about focusing on the death. It's about reducing uncertainty and making sure the person's wishes can be followed. So we say to review 4 areas: the will, the beneficiary designations, the decision-making authority, and a simple map of assets, advisors, and important documents. So it's really important to know those 4 items to make sure that everything is in order. We also say that to confirm who can act as a financial, legal, and health authority for the person as well too. Those are really significant items that need to be discussed and documented. These type of questions are easy to address while the person can clearly express their wishes, and way more difficult down the line if they're not able to express their wishes. So the last point here is I want to mention that a lawyer, accountant, and a financial advisor have different roles to help you, but their advice should be coordinated so that the legal documents, the tax outcomes, and the account designations point in the same direction. So in lots of cases, this is not the case. So it's good to get organized early and make sure you have everything in place. That kind of transitions us to the next thing I want to talk about, which is the tax-free savings account and the differences between a successor holder and things like that. So there's two types of designations where you can designate someone as a holder of your tax-free savings account post-death, and that's through a successor holder or through a designated beneficiary. The most important thing here is making sure you understand the differences in both. Some people choose one over the other, but I just want to go over the quick, easy example of why one might be more beneficial in your case than the other. So a successor holder is a survivor spouse or common law partner who becomes the new holder immediately. So it's very easy. There's no paperwork involved, and it's a quick transfer. The TFSA and post-death growth remain sheltered and become the successor holders. So it's a huge tax advantage if there's a lot of funds in that TFSA. In the designated beneficiary, it's a little bit different. It does not automatically become the holder. The beneficiary, that is, doesn't become the holder of that account. And the account contracts, promises, and timing matters. It's a little more technical, but it's not as simple, and you don't continue to hold the account. It just kind of dissolves. So we'll go over a quick example here. Is for a spouse in British Columbia, successor holder is usually pretty simple. So say Priya has $100,000 on their TFSA and names her spouse Daniel as a successor holder. So with the successor holder, Daniel becomes the holder immediately, and the TFSA continues. Post-death growth remains sheltered, and the $100,000 does not affect Daniel's TFSA. If this wasn't done, Daniel may have, some other complications where he may still have an exempt contribution amount, but there's different conditions and a rollover period, and CRA forms are applicable. So it's a little more complicated, but I don't think we have time to into these items. But I would just recommend investigating the successor holder section and kind of going from The next item I want to talk about is transfers and gifts. So typically, gifts are a huge part of, the process and things like that. So a well-intentioned gift can still create a tax result or a tax burden. Giving capital property to a child or another family member can be treated as a sale at fair market value, even if no cash was received. So it may trigger a capital gain. There are some caveats where qualifying property transferred to a surviving spouse or a common law partner may receive a tax-deferred rollover. The key word is deferral here, that the gain typically on those capital assets is generally postponed rather than eliminated. But they definitely have some benefits because taking those qualified property transfers to a spouse or common law partner is usually beneficial. Gifts to qualified charities also may generate donation tax credits, and estates have specific timing and reporting rules that are there as well too. So those are all significant to talk about. Gifts should be contributed. Gifts should be coordinated with the will and with the estate's need for cash. So it should be, organized with those items in mind. Before transferring any significant assets, ask the questions: what tax is triggered, who needs the assets, and does the legal plan match the intended result? Next, I just want to bring everything together. Here is a minimal plan that a family can begin without taking on another major project. So we want to make sure that, these items we're discussing today aren't a major project for you. They're going to actually help you. So 3 takeaways that we're asking today everyone to do is, if this feels too much, begin with only these 3. Today, choose the trusted person who will own the paperwork and give the person permission to contact the accountants, the lawyers, and the financial advisors. We also say, hopefully this week or next week, start one folder and ask the medical practitioner, if you have one, about the form T2201, your disability tax credit. Add recent tax returns to the folder, add some medical receipts to that folder, and create beneficiary statements as they become available. Once you kind of book a coordinated review of disability tax credit and medical expenses and caregiver claims and estate decisions, you can focus on, what to do next and organizing the estate as. Oops. So I'll close with this one idea I hope everyone will take away. If you do one thing, choose one trust. If you do one thing, choose one trusted person to coordinate the tax and estate checklists that we've mentioned earlier. So thank you everyone for joining us today. And now we'll open the floor for some questions. We probably gave a lot of information here, so hopefully it wasn't too technical.
Thank you so much, Harry and Jane. Firstly, for sharing your own personal family connection for ALS. taxes can be very overwhelming, but your thorough breakdown of the DTC eligibility and provincial benefits are very good. So we do have some questions ready to go, and we invite everybody to go ahead and type their questions into the Q&A button. And if you're not able to find that for any reason, you can also put them in the chat. So I can go ahead and start firstly with a comment. We do have one comment here. My doctor charged me $150 to complete the DTC application, but considering the tax benefit, this was well worthwhile. And we have a follow-up question. Can one still claim eligible home accessibility renovations as both a home accessibility tax credit and a medical expense? Or has CRA changed that for 2026?
Yes, so in 2025, you were allowed to. In 2026, I believe you are allowed to as well. I would say I'm not 100% sure those did change, but if you have any uncertainty and you would like to do that claim, I would contact the CRA and get that agent ID and document the time that you made the phone call and the instructions and items that the CRA said to you, so you can verify that you can claim both of those medical expenses and home accessibility, right? So that you'll have that document to show your accountant or the CRA in the future, and they'll be able to pull up the record of that call.
Yeah, I think just to add to that, like I think one of the issues of the CRA is they're becoming quite strict in terms of how claims are being processed and some of the programs in place. So, as we're moving forward through 2026, they're coming out with new policies where they're restricting, double dipping in terms of claims. They used to allow, claiming those under dual purpose uses, and I think they're moving in the direction where, it's one or the other.
Great, thank you for that. And if there is a follow-up question to that, please go ahead and type that in. Now I'll move on. Does the DTC or other credits require the patient to be a permanent resident or citizen, as the caregiver is a Canadian citizen?
Can you repeat the question?
Yeah. Okay. So, does the DTC or other credits require the patient to be a permanent resident or citizen? And the second part, the caregiver who's the patient's son is a Canadian citizen.
Gotcha.
I think the more important question would be, is the non-resident filing a tax return and have a filing requirement first? And once that's determined, then we could go down the channels of seeing appropriate steps for determining if they could apply for the disability tax credit. Because they would need to file a tax return to claim that disability tax credit, or to transfer it to their, son or the person that they're transferred to.
Okay, great. So with that question, if there is a follow-up, please go ahead and type that in. I hope I explained that. You there? Another question, are gifts from a parent to adult children exempt from attribution rules for gifts to family?
Gifts from an adult parent?
From a parent to an adult child, exempt from attribution rules for gifts to family.
I think that it depends, right? So it's really specific on like what kind of gift we're talking. Like if it's a cash gift or it's capital property or shares. There's different rules when it comes down to the attribution rules, like a kitty tax and things like that. So that would be a little bit of a loaded question. I think it would be or a little bit of case facts and analysis and then response.
Wait, thanks. Okay. So this is a suggestion comment here. I'd suggest the first step in applying for a DTC should be a review of the applicant's income. For persons with low income, it may not be beneficial to claim the DTC.
I think it really matters to if the person has low income, but they have the ability to transfer the DTC to their spouse or another party, then that benefit can be used elsewhere, and those funds can then be used for their care. So the income test isn't the most important. It's more of, is there anyone who might be able to actually utilize the disability tax credit, even if the recipient's income was low?
And then we got to look at the DTC as, a gateway credit, right? So the meaning behind that is it opens the door, opens the gate to a whole bunch of different credits across the board. So whether you're low income or high income, you still have access to different types of credits outside the scope of the DTC. So very important. We always stress if you can do an application, do an application. It's definitely worthwhile to explore the other benefits available.
Thank you. There is a question along the same lines, and I'm not sure if you're able to answer this, but if there is a limit on income to receive the DTC.
I don't believe there is a limit on income. It's not an income tested tax credit. There are other benefits associated with the DTC that may be income tested, but a specific tax credit is not tied to your income. So you could be, a high income earner or a low income earner and still qualify for the disability tax credit. It just has to be following the basis of, that impairment and nature of the impairment. And as long as it's satisfying the CRA's conditions regarding severe and prolonged impairment.
Now we have a question for individual bank accounts and investment accounts. Is it a good idea to change these accounts to joint accounts with your spouse? For investment accounts, would changing to joint accounts trigger tax liability?
Yes. It's that again is kind of a little more of a technical question, just depending on the specifics of the wills that they have, the whole plan intention as well too. But let me give you a hypothetical example. If there was no will and they wanted to set up a joint account, it would be easier for the transfer of assets to go into the person's account with a joint account. But is it required? Probably not. And what are the intentions behind it? So the question would be, during the period of where both parties are alive, you would have to do a lot of additional accounting to reattribute the income back to the person whose accounts they were. So it would be a little more work involved in doing it that way.
Generally, the starting point for making an assessment on that side of things would be looking at like your conversation with your estate lawyer, getting that advice there. What are the legal steps to do? Joint survivorship clauses on accounts and different investments and what their advice is. Then they would bring that report to the CPA. The CPA would analyze the plan, and we would be able to, speak to the tax consequences or, provide additional advice over, taking a certain route over another.
Hey, we have another question here. How do you designate the successor to TFSA? Does it need to be in the will?
No, it would be done at your financial institution. So you would, book a meeting with your financial institution and tell them that you would like to do that. And that would be the easiest way. Done.
Yeah, the easiest way to frame that discussion is booking that meeting with the financial advisor and just starting out the inquiry about you want to learn the differences between, whether setting up the individual successor or beneficiary, what's the differences, and what would be the best rate for you specifically.
Perfect. Thank you. Now, next question. Is this accurate to say that the maximum tax return from disability tax credit, even if it's transferred, is around $1,400? Maybe.
I wouldn't say so. Like maybe you can say for if you're looking at a single year, but the big caveat is this credit is a retroactive credit. So what that means is if the CRA will look at the date that you first experienced those impairments, and they'll retroactively bring that credit back up to 10 years into the past. So if you were to get that $1,400, depending on what the amount was each tax year, and if you paid taxes in that year above, the maximum limit, you could recover all. So we've seen recoveries like upwards to like $30,000-$40,000 in taxes, right? So I think that answers that question.
In the first year, there's additional benefit that multiplies as far back that you could go.
Thank you for that. Now we have a question from a CPA who actually has a PLS diagnosis. Now here's a question. Have you looked at using a PHSP for individuals who are incorporated or has a proprietorship to avoid the approximate $3,000 expense or claim the expense directly off of proprietorship income?
Familiar with I'm not familiar with the question. Maybe we can share our contact information with them. They can send us an email and we can connect offline on that.
Okay, wonderful. Because that was their suggestion as well, that they would like to speak with you directly. So thank you for that. We could definitely share your information. And before we open up to any further questions, we do have a comment for him too. Thank you for an excellent seminar. The Jani boys know their stuff! !
Thank you very much.
So if anybody does have any more questions, we can go ahead and answer those. And if not, if Jay and Harry do provide their contact information, we can.
Yeah, absolutely. I think that's a lot of information to cover in an hour, and we're open to sharing our contact information. Our goal is to help the community, number one, and if you do have additional questions or need any support, feel free to reach out to us. More than happy to connect and give you that advice and be there for each other, right?
Okay, so if there are no more questions, we will be ending the webinar this afternoon. Thank you for everybody that joined in, and a special thank you, Jay and Harry. That was very informative and greatly appreciated.
Thank you.
Yeah, thank you for having me.